Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, it's a Morningstar Conference Special brought to you from Amsterdam. The Morningstar Institutional Conference is host to some of the best investors, academics and thought leaders, and we are excited to share with you a packed podcast this week with senior editor Emma Wall interviewing all of the key speakers at the conference. Let's start with Christopher Davis, chairman of Davis Advisors, who discusses an important question: when is the right time to buy stocks?
Hello, Chris.
Hello, Emma.
So you've done a lot of work about investor philosophy, investor sentiment, and how people tend to buy at the top and unfortunately sell at the bottom. How does this concept relate to the current market conditions? Because we have had significant rally in US equities.
Well, what's interesting is, of course, as it was recently characterized, this is one of the most hated rallies in US equity history. People seem to be looking for excuses not to invest. When stocks were down and were cheap, nobody wanted to invest because they hated stocks, memories of the financial crisis. Stocks have come back, they don't want to invest because of uncertainty. My grandfather had a great expression. He said, the best time to invest is when you have the money. And the way you smooth out the gyrations and the fear of the correction that's inevitable, the timing is uncertain, but that there will be a 20% correction is certain, is simply by spreading out the decision over time. I think people that are anxious and worried about valuations in the market should simply get started, because the valuations on cash and bonds is way worse.
I suppose it also depends on your time horizon, because if you need the money in 6 months' time, perhaps investing in US stocks is not the best idea because of that uncertainty element. However, if you have a 10-year time horizon, the bumps along the way are less of a big deal.
Absolutely, and spreading out the decision, that's the key. And it's not just for individual investors. So many institutions would perform better if they simply made the allocation decisions more gradually. So if somebody, if my own mother wants to get into stocks, what I tend to tell her is start immediately. Do 5% today, do 5% next quarter or next month, depending how long you want to spread it out. But 5% a quarter gets you fully invested over 5 years. And it takes all of that anxiousness about the timing away, and it allows the growth underlying to be the driver of your return.
Do you feel that it should be automated in some way? Because 5% a quarter sounds easy from where I'm sitting today when the market has done so well, despite the fact that it has been such a hated rally. But as soon as that correction comes in, behavioral finance teaches us that you won't want to put that 5% in.
Oh, of course. This is the area where automating, whatever you can do in a sense to automate that decision, to take away the stress of the daily decision. This is the reason why 401k investors have done so well. They bought right through the financial crisis, the sort of deliberate, constant, the apathy, not looking at the statements, is an enormous advantage, provided you've made the right allocation to begin with. Of course, what's happened for some 401k investors is they just sit in cash straight through, and then that undermines the strength of it. But if you set a 401k plan to just put a certain amount into equities each month, each paycheck, that is almost guaranteed to produce a good return over time. And I say that not based on my own knowledge, but Ben Graham wrote that back in the 1930s. He said a systematic approach to investing is almost certain to work out no matter when somebody starts, provided that it's adhered to conscientiously and courageously. And the best way to do that is to automate it.
Chris, thank you very much.
Thank you so much.
Why should we care about environmental, social and governance issues, also known as ESG, when investing? Mats Andersson from the Global Challenges Foundation talks to us about why ESG is important and reveals the essential components and the fund providers who are getting it right.
Hello, Mats.
Hello.
So why should we care about ESG, about environmental, social and governance issues?
I think it's absolutely vital for an investor to have this on the agenda, because my belief is that you cannot long-term be successful unless you have this on the agenda. And I know that there is a misconception that there is a conflict between sustainability and good returns. I think we get more and more proof it's the other way around. If you do this in a smart way, you will actually lower the risk and enhance your returns. And that's exactly what asset management is all about.
And I think there is a misconception there. I think a lot of people have an idea of ethical or hippie investing is about actually screening out some negative stocks which can be high growth, and therefore you're having to choose between a profitable portfolio or a sustainable portfolio. But actually your studies have shown that that's not the case at all.
It's not the case at all. I think that what the problem is and the challenge today is that 95% of all pension capital and capital as a whole is evaluated on a yearly basis. We know that the mandate, we know that the savers will be there for 10, for 20 years. And if you can prolong the time period where you evaluate this and actually give the mandate to the asset owners or the asset managers to really make sure that long term you find the good companies, I'm sure they will understand this is a way to enhance your return. Because short term it's a random factor, I agree. Long term it's absolutely essential that you have sustainability on your agenda.
What kind of time horizon are you talking about there? Because you mentioned pension portfolios which can have multi-decade horizons.
Yeah, and honestly, I mean, I was the CEO of Ep28 and we had, by law, we were supposed to invest on a 40-year horizon, which could be a bit challenging. But I think that just by saying that, say 5 to 10 years would make a huge difference to the way managers behave today and what they will in the future.
And are there any examples of best practice where you think, yes, those people are getting it right?
I think there are many examples, and I'm agnostic and I'm a believer in the let the 100 flowers bloom, find your own way to do it, but you have to understand that this is a mandate that I have and this is a mandate I will actually carry out. And once you do that, and there are so many good examples. You have the APs in Sweden, you have FRR in France, you have Hermes in US, you have PGM in Holland, you have APG, you have New York Retirement Pension Fund. So there are so many good examples now compared to 5 years ago. So let's carry on that route.
Mats, thank you very much.
Thank you.
While Brexit remains in negotiation stages, the impact on the FTSE has already been felt. How can investors navigate the UK market as the political backdrop changes? Our next guest, Derek Stewart, manager of the Artemis UK Special Situations Fund, is here to explain.
Hello, Derek.
Good morning, how are you?
I'm very well, thank you. How are you?
Very well, thanks.
I thought we could start by recapping what effect Brexit has had on markets, because it has had quite an impact.
Yeah, the obvious effect it had on day one was the currency. And again, the great thing about the UK stock market and the UK economy is we're a trading nation, and 60%, over 60% of the earnings from the FTSE 100 come from overseas. So you had this amazing effect of sterling falling 15% pretty quickly and effectively revaluing some of the earnings for a large chunk of the market. So the market, having collapsed quite quickly, then realised the sterling effect and rallied quite strongly. So you had this discrepancy from the overseas earners and the domestic earners, but you actually, since then, you've seen an economy hold up relatively well. And indeed, last week at the budget, the GDP figures revised up again, and we see the domestic economy is actually doing okay at the moment.
For investors, it's quite confusing news because we're often hearing from fund managers that it's all about stock picking, that macroeconomics has no impact on markets and actually should focus on fundamentals. But clearly here we have an example of where macroeconomics has had an impact on markets. So how do we navigate that going forward? I
mean, it's very difficult for any company, any economy to be immune from the macroeconomic environment. And it's a fundamental issue, and it's something we've got to be aware of. But I think there's an awful lot of noise that's out there. And in terms of people's ability to forecast the macroeconomic environment, that's very difficult. I mean, again, you saw that in the aftermath of Brexit, people slashing their GDP forecast for the UK for 16 and 17. I mean, in fact, there were some analysts in the city who thought we'd have a recession in the UK in the fourth quarter of 16. Now, that's not happened, and it just demonstrates to us, how difficult it is to forecast the macro. Now, we look at the companies, we get our macro views on inflation, on growth, on demand, from what the companies are telling us, because they are closest to the mine shaft. They are closest to the customer. And most of these customers are saying, all of these clients are saying the exact same thing to us. They're saying, we don't know what's happening with Brexit, but at the moment we're getting on with the day job and we're actually doing okay at the moment.
So how do you invest in a market like that? Is it about particular sectors that may do well out of Brexit, or is it sort of back to basics?
I think we have to recognise there are some sectoral volatility when you have macro moves that we've had, whether it's currency or commodity moves or interest rate moves. But for us, it's very much about identifying the single stocks, the individual companies that can do pretty well in most situations. So our style of management is to identify companies that, the macro is an issue, but there's so much going on internally, there's so much they can do in their own markets, there's so much self-help they can bring that actually, no matter what the macro, they can at least advance forward. Let's bear in mind that we've had a funny macro situation for years. We've had the situation of the great financial crisis. We've had the problems of QE. We've had the problems of Greece, China, the euro, elections, politics. It gets thrown at us, and we've got more to come. So actually focusing on the individual companies becomes even more important.
And do you have any individual stocks that you think at the moment the time is right?
There's a variety of stocks that got treated very harshly post-Brexit. There's a variety of stocks that have actually had problems last year. We've got positions in Tesco, which has had publicised problems both from discounters and from historic issues over expansion. We've got a company like Cobham, which is in the aerospace sector, which again has had a number of profits warnings. Again, aerospace is a growth sector, defence, we see the spending that's coming through. So again, a lot of self-help to come through in this company. Bovis Homes is another company where it's a house builder that's had problems, and you could buy the shares not long ago at net asset value. There's a selection of companies out there, and for us, there's always a company that's having problems. If we can get the right management teams behind these companies, then we can make some decent money.
Derek, thank you very much.
Thank you, Emma.
Are European stocks overvalued? Isabelle Levy, founder of Metropole Gestion, is our next guest to explain how she uses fundamental industrial analysis to avoid value traps and identify the fair value of European equities.
Hello, Isabelle.
Hello.
So I suppose I could start with considering the rallies we've seen in Europe, in the UK and in the US. Are markets overvalued at the moment?
Well, we don't think the European markets are overvalued, because if you look back, we had a rally, of course, at the end of last year and even this year. But the fact is that for the past 4 years and from 2011, we had so many fears in Europe about the destruction of the Eurozone, about the lack of growth comparing to the American market or even comparing to emerging markets, that basically we didn't recover the undervaluation we had comparing to the American market. So it's only a start, I would say.
Value is something that can be very personal, and there are a number of value metrics that individuals use, investors use. How accurate do you think these metrics are?
I mean, we have to look at, of course, the market. Some people in the market are local to global metrics, PE, price to book. So we have to look at them, obviously. And if you look in terms of PE, the PE of the European markets are much lower than the PE of the American market right now. So I think in terms of undervaluation comparing to the American market, it's obvious if we take a global measure. Then I would differ a little bit, and choosing different measures depend on the company and the sector we're talking about. So we have to take a global approach about the market, but also a specific approach, companies by company. So sometimes the PE for a company which is very cyclical and it's at the bottom of the economic cycle without producing any earnings, obviously the PE is very high, but it's very inexpensive because you are at the bottom of the economic cycle.
I suppose then it's a case of not being a slave to the data, because this in fact can lead to value traps which can catch out investors and mean that they lose money.
Yes, they can lose money, but it depends then on the horizon you have in front of you. When you are an equity investor, I'm afraid to say that we have to look very long term. And some people are talking about 3 years, 2 years. What is long term is all the definition about long term. But if you look at the regulators, they obliged you to write on your prospectus that long term is at least 5 years. So being an equity investor should mean that you have money for a long time and that you can wait. So this is very important to keep that in mind.
Isabelle, thank you very much.
You're welcome.
Up next, Morningstar senior equity analyst Jim Senegal explains 5 factors influencing the share price of financial stocks and how investors can interpret them for profit.
Hi, Jim.
Hi, thanks for having me back.
Thank you for being here. So you have 5 factors that influence financial stocks. What's the first of these?
Yeah, there are 5 questions on everyone's mind. The first question is what is going on with interest rates? The Fed has started to move short-term rates up. A lot of people are looking at that as a panacea for financial stocks. We're a little more cautious. We think a lot of the factors that have been keeping rates low, demographics, changes in technology, demand for borrowing within the US are much slower to change than only over the course of only a few months. So we think it'll be a long process of rate normalization.
And our colleague Bob Johnson in the US thinks that the same thing. He says interest rates, although they've signaled that it'll come up a couple of times over the next year, actually it'll be a slow and steady pace.
Yeah, that's exactly right. I think one of the lessons the Fed has taken from the Great Depression, from Japan, is that the one thing you don't want to do is move too fast. And there are a lot of factors that still point to the need for very low rates. Though the unemployment rate is low, there are still a lot of people that have left the workforce. And those trends, the automation, offshoring of jobs, what's really taken away from labor, that takes a very long time to reverse. And it's hard to see how that changes, to be honest, over any short period of time.
So that's interest rates. What's the second factor?
The second factor is regulation. We have a new political regime, and people are wondering how much that is going to help the banks. There's talk about tax cuts, there's talk about reversal of Dodd-Frank, and here too we think the market has gotten a little bit ahead of itself. If you look at Dodd-Frank, for example, we're 7 years past the passage of the bill, only 80% of the rules are finalized. So reversing that is not going to be an overnight phenomenon. And the other thing people forget is the banking industry is very competitive. A lot of the benefits of things like lower taxes are going to end up flowing through to bank customers, not necessarily bank shareholders.
I think that's very true on what you say about the market getting ahead of itself, and that perhaps could be a query leveled at the whole of the S&P. I think a lot of this benefits of Trump are already being baked into prices, so maybe a bit of caution needs to be shown.
Yeah, that's exactly right. I think the one wild card is how much optimism changes. There's kind of a self-reinforcing cycle where if people get excited about the economy, excited about the prospects for the US, they start to spend, they start to hire, and then the economy does actually get better. I think that's the thing that's hardest to predict. How much of Trump's talk is going to actually influence people's behavior?
And the third factor?
The third factor, moving on to payments, we're seeing merchants get more heavily involved in the payment space. It's very expensive for retailers to accept electronic payments, so merchants are really negotiating for lower prices, and they're also trying to take back control of their customer relationships. For a long time, rewards have come from banks, from card issuers. Now merchants are trying to get in on the act. They're the ones that want to be handing out the rewards to their customers, not the banks.
So interest rates, regulation, payments, and number 4?
Yeah, fourth is another factor within payments, changes at the point of sale. We're seeing things, the point of sale move from card swipes to completely digital payments. People are paying more and more with their phone, although it's a slow process, more and more digitization. So what we're seeing is companies that make the hardware that enables card swipes, they're really in a tough position because 5-10 years from now, no one is going to be swiping the cards. It's going to be 100% digital. It's the software companies that are really going to benefit there.
We've certainly seen that in London, getting onto the tube, the metro, the subway. People are increasingly just putting their iPhones down, and that's what they're doing instead of having a piece of card.
Exactly. We've been waiting a long time for electronic payments to come. I think the whole 10 years I've been at Morningstar, it's been something that's off in the distance. Now you're actually starting to see it occur in the wild.
And what's the fifth and final factor?
The fifth is valuation, probably the most important from our view. And as I pointed out, the market's valuation of financial companies has changed completely over the last 3 months. For most of the past few years, financial stocks were very cheap, but they've gone on a tear since the election. And now a lot of financial stocks are looking expensive.
Jim, thank you very much.
Thanks for having me.
Our next guest, Hilda Jensen from Skagen Funds, admits that emerging markets have disappointed investors over the past 3 years, but valuations are attractive and reforms are boosting returns. The time may be just right to invest in emerging markets.
Hello, Hilda.
Hi, how are you?
I'm very well, thank you. Unfortunately, emerging markets have not had a very good rap in recent years. They seem to be very out of favour, and this is despite, in the last 12 months, having pretty healthy returns. Why do you think people are so against emerging markets?
That's a great question, and I think a lot of the unpopularity in emerging markets is because people have been disappointed over the years, especially the last 5 years. And people are disappointed because they keep waiting for corporate results to become stronger and companies to show better health, but it just hasn't happened at the speed that people were hoping. What we're seeing now that makes it interesting is a lot of changes in the various economies around the world that make this a particularly attractive market.
And it's a very attractive valuation point of view as well. Despite the fact that we have had a rally from the last 12 months, it's come from a very low base. So this is a good time to get in.
I think so. Well, clearly we are a value-based manager, and we think long-term about business models and which companies that are able to thrive in various environments. So with that, we look at the long-term path of earnings trajectories and take that into account when we make our investments. But what we do see is that corporate earnings are getting stronger, cash flows are improving as well, which is really important, and that's an important thing to look at long term as well. But we see underpinnings and some of the tailwinds are actually coming from reforms in various markets that also touch on the way that businesses are being run around the world.
I think that's a very important point, because traditionally emerging markets were seen as higher risk, and they do come with a lot of volatility. People think emerging markets means no corporate governance, no shareholder rights, and therefore they are less attractive than investing perhaps in a developed market equity. But actually that's increasingly not the case, isn't it?
Yeah, and I think that's really important when you look at a company as a potential investment, is not to see necessarily where the company is at the current moment and how well it's being managed, but where could it potentially be in 5 to 10 years from now. And that's where we are mentally when we're looking at potential investment opportunities.
Hilda, thank you very much.
Thank you.
Franklin Templeton's Michael Hassenstab warns investors that there is little value left in bonds, and so not to be too complacent about rising interest rates, as he predicts the bond bubble is set to burst.
Hello, Michael.
Hi.
So this week we have had a Fed rate hike, which has actually been received in rather muted language, especially by the media and by some investors, saying, yes, we've had one rate hike, but hey, we won't have any other this year, despite what Yellen has said. What do you think about this reaction?
Well, I think it speaks to a bigger issue, is that people are very complacent about interest rate risk and are very complacent about the risks in the bond market. If you look at the underlying fundamentals, inflation is rising, growth is resilient, President Trump's proposals all are stimulative of both growth and inflation. So maybe the Fed hikes 2 more, maybe they don't, but the reality is either they hike and normalize and prevent getting behind the curve, or the market will do it for them. Either way, interest rates need to go higher.
I think we've heard a lot about this bond bubble set to burst. I think I first wrote a story with that headline about 6 years ago. Why now? What is the perfect storm, which means actually people need to sit up and take notice?
I think we've crossed the tipping point in terms of the employment market in the US. We're actually starting to see wage growth. We're seeing shortages in the labor market. The number of job openings is greater than companies are actually able to find labor. And particularly in the US, the change in immigration policy is going to lead to further shortages in labor. And the economy has now recovered in terms of its output levels from the crisis. So we're running at full growth potential. We have a labor shortage that's beginning to develop, and you now have a very stimulative government policy in the pipeline in terms of tax cuts, deregulation, fiscal spending, all this at the same time that you have a pro-cyclical Federal Reserve that is stimulating as well.
And the US is a large part of the market, but it's not the entire fixed income sphere. So does that mean perhaps people need to look outside of US listed bonds in order to get some growth?
I think absolutely. People often view emerging markets as risky. The reality is there are risks, but in emerging markets, in many cases, you're actually getting paid for those risks. You can actually earn higher real yields, in many cases double-digit nominal yields in places like Brazil or Argentina. Not to say there aren't risks, but at least the compensation is there, and they're less correlated with what's going on in some of the core markets.
And this is something that we've seen since the financial crisis, individuals being forced to take on more risk in order to get the reward, the financial reward that they would like. How long does this environment last? When do we get back to investing 101?
Yeah, well, I think that is a very dangerous thing, that people are buying just because there's nothing else to buy in the government market. I would say the difference in emerging market local currency debt, it's already blown up. For the last 3 years, it's been the worst performing asset class, so valuations are cheap. So you have a window of opportunity here where valuations are cheap, the fundamentals actually look good. Now eventually that will reprice, but for the next probably 1 to 2 years, it's actually one of the few areas of value left in any of the financial markets.
Michael, thank you very much.
My pleasure.
Which funds are worth paying for? High active share funds, that is, those managers who take off benchmark bets, outperform those low active share. So ban closet trackers from your portfolio, suggests finance professor Martin Kramers.
Hello, Martin.
Hi, how are you?
So the first question I'd like to ask is, what is active share?
Active share is a very basic measure of how different the holdings of a fund are relative to the holdings of a benchmark. So benchmarks have zero active share, they have fully overlapping holdings, right, with themselves. A high active share fund means that the fund invests very differently, that the weights of the fund are very different than the weights of the benchmark. So at very least you know you're going to get something very different.
And your studies have looked at the correlation between active share and performance. What is that correlation?
It's hard to predict performance, right? It's a bit of a fool's game. At the same time, we find one really very strong result. And that is that the low active share funds, so these are funds that have a lot of holdings that are the same as the holdings in the benchmark. They have substantial overlaps. That those funds with low active shares below 60% or so, that they substantially underperform. On the upside, there is much weaker evidence. Active managers have had a hard 10-15 years. But there's some evidence, depending how you look at it, that the high active share managers, even as a group, have performed fine.
Does that mean as an investor I should ignore passives entirely and just go for those high active share funds?
I would say the opposite. If anything, most funds are not that high active share. So unless you know that a fund is high active share, then I think passive is for many investors the right approach. At the same time, I like the core satellite approach, where the core would be passive, but then for the satellite, you go wide and you diversify well and you choose high active share managers. Within high active share, what I found is that a certain patient approach works best. And so I just wrote a new paper called Active Share and the 3 Pillars of Active Management. The 3 pillars are skill, conviction, and opportunity. Skill is hard to measure, but high active share means at very least that the manager has the courage of the manager's convictions and a lot of opportunity to actually be different. And so in my view, having a high active share means at least having conviction and opportunity. And in general, it takes a lot of skill to successfully run a high active share fund over a while, for a while. And so on average, we find that the patient high active share managers have done well. That's what I would suggest for the satellite.
It's really about eking out those closet trackers, those people you're paying for active management that are actually doing no better than the benchmark, and being left with pure passive and pure active management.
That's right, especially because many of the low active share funds are not that cheap.
Martin, thank you very much.
Yeah, thanks for having me.
Our final guest from this year's Morningstar Institutional Conference is Professor Gerd Gigerenzer, who says fund providers need to invest in education so that savers are better equipped to deal with risk and can make better financial decisions in the future.
Hello, Professor.
Hello.
So I suppose the first question we should start with is, what is risk?
Now, if you are in a world of certainty, there is no risk. But most of the time, we are not in the world of certainty. And risk is usually a term meant for a situation where you can fairly know the probabilities as opposed to uncertainty. So that's risk. So, for instance, and the problem is that many people don't understand risk, and also others try to mislead you. The World Health Organization recently informed us and warned us that for every 50 grams of sausage we eat, your risk of getting colon cancer increases by 18%. Many of my friends stopped eating sausage because they believed, so out of 100 people, 18 will get colon cancer. No, it was a trick. The risk increased from lifelong about 5% to almost 6%. That wouldn't cause much fear, but instead of saying 1 percentage point or less one, it's 18%. So from 5 to 6 would be 20%, it's less than 80%. And it's a common trick, it works for most people, and one can steer their emotions and their behavior.
And how does this misinterpretation of risk impact investors and their portfolios?
Oh, we know from studies that even professional brokers and people who are in the investment business do not really always understand what volatility means. So one study in the US, in New York, showed that most professionals confused volatility with the average deviation. Volatility is a standard deviation, which is larger, so they underestimated volatility. That's one example. Another one is that the general public is not financial literate, with very few exceptions. And I think we need to do something about that. That we create a society where people can make informed decisions. And we are not there, and we do very little about that.
That was going to lead on to my next question, is what can we do? What can we do harnessing what we know about behavioural science, perhaps, to make sure that we don't come a cropper when misinterpreting risk?
One thing to do is start early, say in school. And our children learn lots of things. Few of them they will need the rest of their lives. But how to deal with money? How to deal with health, how to deal with digital media, to control this rather than being controlled. Yeah? Those would be important things. And if only some investment firms would invest in the education of their own general public, that would be wonderful.
Professor, thank you very much.
Thank you.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.